Welcome back to the Retirement Master,
an Excel spreadsheet dedicated to helping you plan for your retirement and then living it to the fullest. This is the 13th video in a series of short videos that will demonstrate just how the Retirement Master works and what it does for you. This film is on the S&P 500 performance history. I'm going to just scroll down here to a little bank of questions that I have. And what I want you to do is to freeze your screen, answer these questions, and then come back and we'll review them. Okay, welcome back. Let's just dive right into these questions. Between 1950 and 2020, a 70-year time period, what was the average annual compounded rate of return for the S&P 500 index? Your answer? I hope that it was 7.81%. Okay, between 2000 and 2020, what was the average annual compounded rate of return for the S&P 500 index? Much more recent time period, you probably got a really good handle and a memory on this one. I hope your answer was 4.02%. Not nearly as good as the 70-year average was. Okay, here's a fun question. What percent of financial advisors typically produce a rate of return for their clients that exceed that of the S&P 500 index? I hope your answer is less than 25%. Less than 25% of financial advisors produce a rate of return for their clients that exceeds the S&P 500 index. So if you're just after maximizing your rate of return, just go stick your money in the S&P 500 index and don't pay anybody, and you'll do better off almost always. But there are other reasons to hire a financial advisor, and even though the rate of return may be lower, it may be well worth it for you. Okay, between 2000 and 2020, what was the maximum number of consecutive years that the S&P 500 index showed an overall total rate of return that was negative? So the S&P 500 is clicking along and it has a downturn. And how long does it take for it to recover? Now, during that 20-year time period, it had up and downs several times, but what was the maximum or the longest length of time it took to get back to where it started? Your answer? I hope it was over 9 years. Okay, we're going to talk about that a little bit more later. I'm going to click on this tab down here at the bottom, the S&P 500 Performance tab. And I'm going to show you some data. Here's the years, 1949 through 2020. And this is the closing figure for the S&P 500 on December 31st of each year, and how much the S&P 500 grew by that year. So it was at 16.76 back in 1949. Not a very big number. Fast forward, we are now at the end of 2020 at 3,756. You might think that is a huge increase, but because of the power of compounding, to get from that number of less than $17 to $3,700, it only took a 7.81% annual rate of return. Okay, going back up here to the top, for those of you that think the stock market always goes up, look at these highlighted numbers here. These are negative numbers. These are years where the stock market closed lower than the prior year. And for the most part, when it has a year that it does really poorly, the next year it's recovering from it. As you can see, here we had 2 years in a row, however, where the total was almost half of the value of the stock market. Okay, I'm going to drop down a little bit further, and we got some more single years. But here we have, for the first time, a triple, 3 years in a row where the stock market closed lower each year than the year before, losing almost half of its value. Now, some of these years when it drops, it's a small drop. Here it's less than 1%, but here it's almost a 40% drop in 1 year. So the stock market does not always go up, and sometimes it takes a while for it to dig out of the hole that it dug for itself when it goes down. Okay, going up to the top, and I'm going to move over a little bit here. Okay, now here's the 70-year average, and the longer the time period we're looking at, the less variation there is, should we say. So here's a rolling 30-year time period, and you can look at the averages. Here we get into a 20-year rolling average, and you start to see some numbers that are much lower. And then you drop down here further, and we're into a 15-year, and you see some numbers that have a lot of variance. 10 years, same thing, same thing, same thing. And then when you get into 5-year periods, you see even more of it. So you got period like here and here and here. Even this isn't all that great. So the stock market does not always go up. And sometimes you got like a 5-year period or a 10-year period where you have very, very poor performance. But overall, it was 7.61% over the 70-year period. But you got these really low periods mixed with really nice periods to make up that average. Okay, dropping down a little further, I'm going to show you a graph. This is a graph of the S&P 500 close over that 70-year time period. And you can kind of see the ups and downs a little bit. The market goes up and down. It goes up and down, up and down. And you might think, well, here it just barely grew, but here it did really nice. Now, the rate of return in this period is just as good as the rate of return in this period. It's just that the numbers are so small, it doesn't take much of an increase to give you that percentage rate of increase. Now, here's something really interesting. Right here, December 31st, 1999, the S&P 500 closed at almost 1,500. Then we had 9/11, recovery, the Great Recession, recovery. We have a 13-year period here where you are at a net negative rate of return. You haven't even made $1 for 13 years, and then it started taking off again. Now, this happens. It's happened more than once. It'll probably happen again in the future. And if you're not prepared for this to happen, then your retirement can be in serious jeopardy if and when it does happen. And one of the great things about this spreadsheet, it'll help you deal with periods where the performance is horrible like this without massively changing your retirement plan. But part of the way it does that is it doesn't allow you to be too overly optimistic. I suggested you had a 5% return for your retirement plan, retirement funds. And maybe after seeing these numbers, you're thinking like, okay, that 10 and 15 and 20% number I was thinking maybe isn't a very good number to use. So I hope I gave you some things to think about. I want you to go back over those charts and over the information I've shared with you and review it and try to digest it and kind of come down to earth with your attitudes and your thoughts about the stock market and how well it does over time. It is a great way to grow your money, but it's not going to make you 10, 20, 30% year after year after year. And so let's be realistic, and I hope these numbers and charts and information help bring you down to earth. On the next video, we're going to deal with how do you deal with a time period like this without it devastating your retirement plan. And that's really quite easy with this spreadsheet. So until the next video, I'm going to wish you happy retirement planning once again. And for many of you, I hope a very happy retirement.